Something historic just happened while most of the world was asleep. The silver market didn't collapse like it was supposed to. It did the opposite. And that single failure may have just exposed the entire financial system. The moment long awaited by physical silver holders has finally arrived, and it did not announce itself with chaos or panic. Instead, it arrived quietly during the Asian trading session while Western markets slept. When Tokyo and Sydney opened, the expectation was clear. After Friday's aggressive paper selling, billions of dollars worth of contracts dumped in a last-ditch effort to push silver back below a critical psychological threshold. The banks needed a collapse. They needed fear. They needed momentum broken before the new week began. What they got instead was confirmation of failure. Silver opened strong, jumped higher immediately, and refused to fall. The price didn't just survive. It held decisively above levels that were supposed to trigger capitulation. That single fact changes everything. This was not a random bounce or a technical fluke. It was a message, a statement, a declaration that the mechanisms used for decades to suppress silver prices are losing effectiveness. When the price held above the mid-60s and then gapped higher, the market revealed something the banks hoped would remain hidden. Their control is weakening. The Friday paper dump was not part of a long campaign. It was a final push. And now the chamber is empty. For years, the bullion banks relied on the same playbook. When silver rallied too aggressively, they would flood the market with paper contracts, overwhelm liquidity, and trigger algorithmic selling. That strategy worked because the market believed in it. Belief is power in financial systems. But belief only holds as long as outcomes reinforce it. This time, the outcome was different. The market absorbed the selling. Buyers stepped in immediately. Price stabilized and then advanced. That is not speculation. That is regime change. To understand why this Monday open is so devastating for major short players, you need to understand the mechanics of their exposure. These institutions are not hedging casually. They are carrying massive concentrated short positions that only remain survivable if price remains contained. Every incremental dollar move higher forces them to post additional collateral. Every sustained move compounds losses geometrically. By opening where it did, silver moved these banks into a zone of extreme stress. Their margin cushions are shrinking rapidly, and their options are disappearing. In normal conditions, a bank facing this situation would simply increase pressure. More selling, more contracts, more leverage. But these are not normal conditions. Liquidity has thinned dramatically. Physical demand has soaked up available supply. The moment they attempt another large-scale sell-off, they risk being instantly overwhelmed by buyers. At the same time, attempting to buy back positions to limit damage would ignite the very rally they fear. Either path leads to catastrophe. They are frozen, trapped between two outcomes that both end badly. This apparent calm on price charts is not stability. It is tension. It is the silence before forced action. Margin calls do not announce themselves loudly. They arrive quietly, with phone calls, deadlines, and collateral demands. When they hit, selling becomes mandatory, not optional. That is when price behavior shifts from gradual to violent. While banks scramble to manage paper exposure, a separate crisis is unfolding beneath the surface, one that cannot be solved with derivatives or accounting entries. Industrial consumers are waking up to a reality they ignored for too long. Companies like Tesla do not consume futures contracts. They consume metal. Each electric vehicle requires significant quantities of silver. Solar panels, batteries, electronics, these are not optional uses. They are structural requirements. And inventories are already stretched thin. What industrial procurement teams are realizing now is that the just-in-time delivery model no longer works in a constrained resource environment. When prices remain elevated and supply chains tighten, waiting becomes dangerous. That is why off-market deals are reportedly increasing. Large buyers are negotiating directly with miners and refiners, bypassing exchanges entirely. Every ounce secured this way never reaches public vaults. It disappears into private supply chains, further reducing visible availability. This shadow demand is critical. It operates outside charts, outside headlines, and outside price discovery mechanisms. But it drains the system relentlessly. And once industrial buyers lose confidence in open markets, behavior shifts permanently. If silver becomes unavailable at scale, the response won't be higher bids, it will be vertical integration. Buying mines becomes cheaper than chasing metal. This is how a supply squeeze transforms into a strategic resource scramble. The engine driving this acceleration is not located in New York or London. It is thousands of miles away. In Asia, pricing signals are already flashing warnings. Premiums in Shanghai continue to expand, indicating that silver commands a significantly higher value there than in Western markets. This differential creates an unavoidable flow of metal. Arbitrage is not ideology, it is math. When silver is worth more in the East, it moves east. Every bar shipped reduces Western inventories. Every shipment tightens supply further. The London vault system, long assumed to be deep and stable, is being drained faster than historical models ever anticipated. The West attempts to suppress price to protect currency credibility. The East uses that suppression to accumulate strategic assets. This dynamic represents one of the largest quiet wealth transfers in modern financial history. For decades, high-frequency trading systems controlled silver price behavior. These algorithms were programmed to respond predictably at resistance levels. When price approached key thresholds, automated selling would overwhelm bids and reverse momentum. That system functioned because liquidity supported it. But today, something unprecedented is happening. The algorithms are executing sell orders and price is not responding. This is algorithmic failure. When automated systems detect persistent inefficiency, they adapt. An adaptation in this context means switching sides. The same machines that suppressed price for years are programmed to chase momentum when resistance breaks decisively. When that flip occurs, buying becomes mechanical, relentless, and emotionless. Liquidity evaporates instantly. Moves that once took months occur in hours. At the same time, the disconnect between paper price and real-world availability is becoming impossible to ignore. Screens may show silver trading in the high 60s, but anyone attempting to acquire physical metal knows the truth. Premiums are rising. Delivery times are extending. Dealers are rationing supply. This divergence signals systemic stress. It means confidence in paper claims is eroding. Paper markets can claim abundance indefinitely until delivery is required. When physical demand asserts itself, accounting fictions collapse. Eventually, exchanges face a decision: deliver metal they do not possess or settle contracts in cash. When cash settlement replaces delivery, trust is broken permanently. At that point, owning a paper contract no longer represents ownership of metal. It represents legal exposure. Structurally, the options market is adding fuel to this environment. Large concentrations of call options sit just above current price levels. As silver approaches those strikes, dealers who sold those options must hedge by purchasing futures. This creates a self-reinforcing loop. Rising price forces buying, which drives price higher, which forces more buying. This is not speculation, it is mathematics. Friday's close ignited the process. Monday's open confirmed it. The next key threshold is not symbolic, it is mechanical. Once crossed, forced activity accelerates beyond discretionary control. That is when markets gap instead of trend. Psychologically, the silver market has changed as well. For years, rallies were met with immediate selling by investors conditioned by repeated disappointment. That behavior is fading. Holders are no longer rushing for exits. Conviction has replaced fear. The silver thesis has evolved from a fringe belief into a globally recognized asymmetry. Retail interest is returning, not cautiously, but aggressively. Investors who watch digital assets explode are searching for the next imbalance. When they arrive in a market as small as silver, liquidity cannot absorb them. The structure simply isn't designed for mass participation. Pressure builds rapidly. Breaks become inevitable. The implications for the banking system are profound. A sustained silver price above critical thresholds places several institutions under extreme capital strain. Losses on short exposure begin to exceed buffers. This is why resistance has been so aggressive. This is why media coverage remains muted. Silence is not ignorance, it is containment. Silver is not isolated. It connects to gold, bonds, and currencies. It is a pressure point in the system. When it moves uncontrollably, stress propagates outward. That is why silver matters far more than its market size suggests. It is leverage on confidence itself. Globally, this shift aligns with geopolitical reality. Nations outside the dollar system are actively reducing exposure to fiat risk. Commodity-backed trade frameworks are emerging. Physical silver plays a role in that transition. Accumulating tangible resources insulates economies from currency instability. In a resource contest, possession matters more than contracts. Supply shortages are cascading through the production chain. Mines struggle to expand output. Refiners face bottlenecks. Mints are already allocating. Factories are next. When manufacturers cannot secure inputs, price becomes irrelevant. They must pay whatever is required to keep production running. That is the definition of inelastic demand. Ultimately, price must rise high enough to force marginal holders to sell. Jewelry, scrap heirlooms, these become supply sources only at extreme valuations. That equilibrium is nowhere near current levels. Notice what remains absent from mainstream coverage. Financial media discusses equities, rates, and macro narratives, but not silver's breakout. That omission is intentional. Attention creates participation. Participation creates pressure. Pressure creates loss. History shows that when exchanges face uncontrolled moves, rule changes follow. Trading halts, margin adjustments, forced liquidations. These actions do not resolve shortages. They reveal them. Closing paper venues does not stop demand. It redirects it. If price holds current levels through the session, historical resistance disappears. The market enters price discovery. Technical projections become irrelevant because no reference points exist. Momentum replaces models. The early phase belongs to informed capital. Public enthusiasm arrives later. That is when volatility peaks. That is when narratives shift. That is when disbelief turns into urgency. The week has begun. The expected collapse did not occur. The thesis stands confirmed. The squeeze is not theoretical anymore. It is active. Waiting for perfection in an imperfect system often means missing the move entirely. Structural repricing does not announce dips in advance. It moves when pressure overwhelms control. The banks bet against physical reality. Reality does not negotiate. Hold conviction. Ignore noise. Watch supply, not headlines. What is unfolding now is not a trade. It is a transfer, and it is happening in real time.